Joining us right now to talk more about the markets is Ross Mayfield, investment strategy analyst at Baird. And Ross, you are somebody who looks at this and thinks that we're just mid-cycle, that this is a bull market that's here to stay for quite a while.
Yeah, absolutely. All of the activity, momentum, breadth that we saw off the October lows are, it's bullish over the intermediate term here. You've still got cyclical leadership. You've got breadth, both in the U.S. and globally. The stocks at the top of the market are working. Earnings are inflecting higher. So there's still, to me, a lot to like about the market, even if, a summer pause or a bit of chop is on the table here in the next couple of months.
The big concern people have been looking at is the health of the consumer. You're a little less worried about that.
Yeah, I think some of the weakness we're seeing is less weakness and more normalization, right? Obviously, 2022 and 2023 were kind of a boom time for the consumer, spending down some excess savings, but we still see solid wage growth. We still have a pretty strong labor market, which is the core of that. And then there are other, signs that things are pretty good. One of the things we look at or have been looking at is the wealth effect from the housing market. So housing prices are up big. Home equity is up big. Obviously, it's a huge concern for inflation and for affordability for first-time buyers. But for the majority of homeowners in this country, and that is a big portion of the consumer, it's a big tailwind.
So what does concern you? What do you kind of keep an eye on?
Yeah, keeping an eye on credit. I think if anything, we'll start to see cracks there first. Higher for longer rates have obviously been digested pretty well by the market, but we know that, every week, more and more paper is coming due and companies and governments are reissuing at higher rates. At some point that weighs, right? That's the whole point of raising interest rates, whether it's office real estate, whether it's something else that's lurking out there. It's probably in that space, but we're watching credit closely. And as of today, spreads are extremely tight. So no signs of concern there yet, but we're watching closely.
I mean, I guess bulls definitely have momentum in their favor. This has been such an impressive rally. You've got everything that's happened with AI and the technology spending associated with that. But it does feel like the bar keeps getting higher and higher in terms of what a company has to do to outperform or impress or even satiate what their investors are looking for at this point. What do you do just in terms of where you're looking, which sectors?
Yeah, absolutely. Well, one of the big themes for us, or for me over the course of this cycle is going to be quality, right? Higher for longer interest rates make a higher bar to clear for companies, as you mentioned, especially when interest expense is a bigger portion of the cost side of the balance sheet. A lot of companies never existed in an environment like this. So high quality across sector. But as of right now, we're still seeing cyclical leadership. We don't want to get too far away from that and chase defensives. It's still a high yield environment, so there's a higher bar to clear for those yield proxies. So we like global cyclicals, but with a quality tilt, even in a bull market, which is maybe a bit rare through history, but we think it's going to be persistent this cycle.
So with all of those nice things you just said about the markets, you are thinking that this is a time to maybe look a little more internationally as well. Why is that?
Well, I mean, broadly, our wealth management clients, like many, are probably over-indexed to their home country, right? So you start from a base of you could probably have more international exposure, but Europe and other developed economies right now are coming out of a bit of a weak patch, so they've got some catching up to do. They're probably going to get to cut interest rates before the Fed, to the extent that that's a tailwind for equities. And their activity is really starting to percolate more out of this kind of mini recession, whereas the U.S. never got there in the first place. So a bit of a catch-up trade. There are more cyclical exposure abroad as opposed to the tech concentration here at home. So I think you could expand globally, and I think when you look abroad at both emerging and developed, you start to see leadership. You start to see different countries at all-time highs. I think it's bullish, but I think you want to be exposed to that both in the U.S. and abroad.